Welcome back to Mortgage 101, your guide to homeownership with Clinton Wilkins and myself, Todd Veinotte, in the fine cities of Halifax and Ottawa. And we've been talking about refinance now. So we're going to get to it, even though you tried to push the agenda to something else. And I said, no, we have teased our audience long enough. It's time to talk refinance.
So if you're an existing homeowner, this segment's for you.
No, more importantly, if you're an existing homeowner with equity in your house, this segment's for you.
You know what? I think if you bought your home prior to 2020, in most areas,
you should have equity.
You should probably have a good amount of equity.
If you don't have equity in your house and you bought prior to 2020, you've got some serious problems.
Or you might have bought in a market or an area that maybe hasn't seen the growth. I don't know. I'm going to be nice. I'll be the good guy here.
I think the vast majority of people who purchased before 2020 would have equity in their house that they had not envisioned. Is that safe to say?
I would certainly agree with you. In Halifax, in our market, pre-pandemic, the average house prices were going up 1%, 2%, 3% per year. Here's an interesting stat, though. We were starting to see spikes in growth and prices in 2019, even before the pandemic.
Yeah.
So, Halifax is a desirable place to be. We have affordable housing here, even though maybe if you live in Halifax, it doesn't feel affordable. But if we look at other areas across the country, our average house price for a detached home is about $500,000.
Yeah.
And that is very reasonable compared to other areas. And I would venture to say that's reasonable even compared to Ottawa. Yeah. At one time, our market was very similarly priced. A lot of federal government employees, a lot of federal government employees in here, in Halifax. And our housing prices were similar. Now, Ottawa is still significantly more expensive than Halifax.
Yeah. Okay. So refinancing, what makes somebody a good candidate to refinance besides having equity in the house?
I think the other factors really we look at income and really what is the reason for the refinance and what's going on with your current term. Yeah. Obviously that's important. If you're going to do a refinance midterm, you're going to pay a penalty in most cases, unless you're going with the same lender. And even in some of those cases, you would still pay a penalty. The people who are refinancing midterm, majority of those people are in a variable rate. Because if you're in a variable and you break your mortgage early, it's only 3 months interest to get out. Mm-hmm. If you were to break your term early and you were in a fixed rate, you could pay a much larger penalty.
How much more?
It's either 3 months interest or an interest rate differential, which is ever higher. The banks are like the casinos. They never lose. Right. Obviously, we look at income and we look at credit when we're doing a refinance, just like any transaction that we do. And a little bit of the mechanics of a refi, how it works. You can refinance up to 80% of the current market value. And the market value really means what you could sell your house for right now.
Mm-hmm. Who determines that?
Usually we get the, insight from the consumer. They usually have a pretty good idea about what their home is worth. Yeah. And that's what we'll start with. And then sometimes lenders are able to use a low ratio valuation system. So they're using data from the Canadian Mortgage and Housing Corporation, from CREA, and obviously any sales that happen within the municipalities. They leverage that data to see if the property value is accepted. If it's not accepted automatically, then you would be required to get a full appraisal. We would order the appraisal, and we're required to order it. And sometimes we can order directly from the appraiser, depending on which lender we use. Or sometimes we have to order an appraisal through a management company. Mm-hmm. And, we'll order it. We'll send the link to the consumer to pay for the appraisal. And then the appraiser would reach out to the consumer to schedule the time to do the inspection and then prepare the report. When we get the valuation solidified, if that is through the low ratio valuation system or if it's from a full appraisal, we can then do the mortgage for a maximum of 80% of that value. And from that new mortgage, obviously we have to pay out what you owe already. Mm-hmm. So I would pay out like any mortgages that were registered to the title of the home, any secured debt, like a HELOC or any of those things, that would be paid. And then any of the proceeds, we could use that to, obviously pay down other consumer debt, do renovations. And I'm seeing a lot of consumers obviously do investments. And a really interesting trend that I'm seeing right now, Todd, I'm seeing a lot of parents either refinance their home or leverage their home or, remortgage their home or whatever you want to call it to give a gift to their kids to get into the housing market. Mm-hmm. I'm seeing a lot of young people, first-time home buyers buying homes, and they have gifts to the tune of 6 figures.
Wow.
And in some cases, they need it. if you put down 20% or more as a first-time home buyer, you can avoid the Canadian Mortgage and Housing Corporation, the insurance, and our debt servicing ratios.
Why would
can
they
be
need
extended.
6 figures for a down payment?
Well, if the average house price is $500,000, you might need $100,000 down to be able to make the numbers work.
Yeah.
In many cases,
Yeah.
The rule of thumb around affordability, we look at the household income, and from the household income, any borrowers that are contributing to that income would need to be on the title. Obviously, we can do the mortgage just in one person's name. But if both are going to be on the title, which would also be on the mortgage, the title and the mortgage have to be the same. We can lend typically 4 to 4.5 times consumer's income for a mortgage. So, for example, if the household income is $100,000, let's say, a year, maybe between one borrower or two borrowers, that means that we can do a mortgage of anywhere between $400,000 and $450,000. That has to be supported by the property value. That can't be any more than 80% of what the property value is if we're doing a refinance. And a lot of consumers are doing this right now. We're doing a lot of refis, which is very different from what's happening currently in the United States. Refinances are actually down about 60% in the U.S.
Why?
I don't know the whys. I think part of it is they might not have weathered the storm quite as good as we did from the pandemic. So I think that's obviously a consideration. And I don't think they had the growth in the property values that we have had.
And they had a huge subprime meltdown as well in 2008. So perhaps
the market is very, very different.
Yeah, very different. And I don't know if it's as heavily regulated as it is here in Canada. Even the banking industry in general.
Yeah, there are hundreds, if not thousands, of banks in the U.S., where in Canada we have a very stable and structured banking system, which is great. Our consumers are protected, and our consumers are getting the right amount of disclosure and information on their mortgage. So, I think the way that we do it in Canada is good. I think that a lot of the reasons that consumers will take a 5-year term, whether that's a variable or whether that's a fixed, is the bonds are out typically for that amount of time. So, just like any market, it's cyclical. Things go up, things go down. Currently, obviously, we are in an increasing rate environment. And, some borrowers want to make a move now before the renewal. And some borrowers are willing to pay a penalty just to refinance early.
Right.
And, if you're looking to do that just to lock in the rate, I don't know if it's worth it, to be honest. Wait to the renewal. But if you're looking to do a refinance with an objective, then yes, sometimes that will make sense. And usually what we say is, it needs to make sense for us to do it. We just don't want to do a refinance for the sake of doing a refinance. We need to be able to put the consumer in a better financial position. That's really our goal.
So if somebody wants to refinance, some things that they can do in advance, some prep work they can do in advance, obviously, is get some documents together. What advice do you give people so that they kind of hit the ground running, so they don't meet with you and you got to start from scratch?
Well, I think the one thing is, it's like you should know what your credit looks like. Oftentimes we ask people, I'm like, how does your credit look? I don't need to know what your score is. We'll get that through our system. But I like to just know, like, what is the matrix of your credit? Like, is it good? Is it bad? Is it ugly? What's kind of going on there? We usually recommend borrowers download Borrowwell and Credit Karma. They're free apps. And, you can see what's going on with your credit. And then have your income documents readily available. If you are an hourly or a salary employee and you have any variable income, we need the last 2 years of your T4s and your current pay stub. If you've just changed jobs recently, we'll need a pay stub and a job letter. If you're self-employed and you've been self-employed for quite some time, 2, 3+ years, we would need the last 2 years of your tax returns and your notice of assessment. And if you're self-employed, there certainly are other programs out there. So if you're not maybe claiming enough income on your income tax to make it work, there's some stated income programs out there. And if you're newly self-employed, there are some good programs for those people too. The federal government really wants to kind of cut the red tape in terms of self-employment. More and more Canadians are becoming self-employed every day. And maybe you want to do a refinance to inject maybe some capital into your business. I don't know. But we're certainly seeing a lot of self-employed people. And there are programs that are available out there that can really make it make sense. And maybe that's a shorter term mortgage. Maybe it's a 1 or 2 year term.
For some people who've been self-employed over the last couple of years, like a lot of self-employed people, they've had struggles and they've had to rely on some government assistance.
Of course.
Like a lot of people have.
Yep.
How does that factor into all of this?
If the income is down, if we can justify it, sometimes we can look at something like a 3-year average.
Right.
We're seeing that for, people that are in the, hairstylists, spas,
Sure.
fitness, travel. We're able to do a 3-year average, I think, in some of these cases. Obviously, if it's recovered and they're back to kind of like a normal schedule, we can't avoid government shutdowns. And I think the lenders understand that. But we need to be able to justify it with some documentation. If you're self-employed and your income was negatively impacted, maybe a stated income program works better for you. And oftentimes these stated income programs might be really more leveraged on what's going on in your bank account. So maybe we'll get 6 months or 12 months of your bank statements to kind of justify that income. And there's lots of lenders out there that will do, stated income programs. It might not be a bank lender, Todd. Bank lenders typically want the income tax to show what the income is.
Right.
But I know lots of self-employed people that make really great income, but on their income tax, it shows that they're making $30,000 a year. I see it.
Is that legal?
I mean, obviously, if your expenses that you're putting into your business can be claimed. I'm not an accounting person and I'm not the CRA, so I don't know. But here's an interesting adage, we'll say. I'm trying to think about how to say this appropriately. You can either pay more income tax or maybe you have to pay a higher interest rate.
Right. Yeah.
I have a funny, I don't know if it's appropriate for the radio, and I don't want to offend anyone, but, you either have to pay more income tax or in some cases, if you're self-employed, you have to pay a higher rate if we have to do some of these stated income type programs.
All right, we've got another segment to go. What do you want to talk about?
Woohoo.
Putting you right on the spot right now. What do you want? What are we going to talk about?
We're going to talk a little bit about what's going on in the housing market here in Halifax.
Yeah.
Obviously, if you're here in Halifax and you're listening, you're living it. And for our listeners in Ottawa, some of you may be wanting to move to Halifax and Atlantic Canada, and we'd love to welcome you with open arms. We just want to kind of give you a little update on what's going on.
Okay, Mortgage 101, your guide to home ownership returns when we come back.